Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we start off this week on a much more, or sorry, we ended last week on a very positive tone here to the equity markets. But we started to. The reality is the fact that the market has rallied a pretty significant amount in the last 3 months off of the April lows, that markets were at this point reaching overbought conditions, even though we have been overbought many times in the past few months, but that didn't stop the markets from going higher. What we did started to see here at the end of last week was a little bit of what we call negative divergence. Maybe I'll enlarge this to make this a little bit easier to see. Basically, what you have are higher highs in price that are no longer being confirmed by higher highs in momentum. And that leads us to believe that there's some exhaustion here on this final push higher that has the higher probability of a bit of a pullback here in the broader markets. And whoops, sorry, I didn't mean to close that out. And given the context of the week that we're in with regards to trade negotiations, tariff negotiations, and the VIX kind of starting off this week around 17%, it really kind of felt like the markets were being potentially a little bit complacent from a volatility perspective as to how that could shake out here this week. We obviously saw how the first time tariffs got announced and how the markets reacted to that. I don't necessarily expect anything like that here this week, but it doesn't take away from the fact that there is quite a few headline risks with regards to trade wars this particular week that I think we need to be cognizant of, that the probability of a short-term pullback here in the broader markets just is a little bit more elevated this week. Last week, we basically broke out to new all-time highs on both the S&P 500 and the NASDAQ. And this week, even though relatively light on the economic calendar, I would say the headline risk this week is much greater. Earnings season is just about to kick off here. We'll have the first real report with Delta Airlines, I believe, on Thursday this week. And then we'll see the banks next week, which will provide a lot more clarity as to kind of what potentially the second half of 2025 might look like from a economic perspective. So taking a look at kind of the NASDAQ 100, so we take a look at the NASDAQ 100, we see very similar price action to the S&P 500. We basically made a new all-time high here last week, but as we continue to make new all-time highs, we started to see some level of divergence here with momentum here on the previous high. And that basically leads us to believe that there is a higher probability of a short-term pullback here. You do have a gap here around, call it 530 or so. That would probably be a good downside target here for a short-term pullback. For long investors, waiting for a pullback would be better from a risk-reward perspective to continue to add longs on this particular market rather than adding longs here and hoping that markets just continue moving higher. Because like I said, the probability of a pullback here is more elevated now that we have some exhaustion and volatility has kind of pulled back to a pretty low level. We continue to see IWM improve here as well. Small caps continues to improve. Our upside target here is around 230 here to the upside on IWM. But, in the short run, things looked a little bit overextended here as well. We've also had a very strong run here in small caps over the last few months. It wouldn't be crazy to see a little bit of a pullback, a little bit of consolidation before markets can sort of continue moving on higher. And then lastly, RSP, the equal weight S&P 500 index, we continue to see that perform on par with the rest of the market. And this really shows us that the rest of the market is playing a little bit of catch up here. As you can see, we're just shy of the all-time highs on RSP. We basically tagged that level here on Friday. Yesterday, we pulled back a little bit, and we'll see if we can kind of break out higher here. If we can break out higher here, that would be a pretty healthy signal for the overall market, or the overall bullishness of this particular market, is to see that upside. So we'll continue to monitor this and see how it shakes out here. But this particular week, I think, is going to be really important for um, investors to be paying attention to how equity markets react to these all-time high levels, and whether or not we can see a little bit of a pullback here, which would potentially be healthy and provide a good opportunity for fresh new longs to enter the market. And then looking at kind of bonds, if you look at HYG, we saw a little bit of divergence here with HYG last week here as well. So similar type setup, basically, as you can see, as we continue to make higher highs in price, we're starting to see lower lows or lower highs in terms of momentum. And that leads us to believe that, HYG, high yield credit, is getting a little overextended and due for a little bit of a short-term pullback here as well. So we're kind of in this market where both equities and bonds have rallied, a fairly significant amount, to the point where I think it's worthwhile to take a look. Now, interesting TLT, as you can see at the end of last week, we did get a bit of a pullback here on bonds. So as equities rallied, bonds sold off, which is actually, the correct relationship between equities and bonds. So the fact that we're seeing kind of that sell off here in bonds, does pull back bonds to a support level that could potentially be a buying opportunity here as well for bonds. So a few different opportunities that we see here in the broader markets. Okay, so looking at the ideas that we have here for the week. First of all, this is from last week. This is a stock that we still quite like here, is Block. For those of you not familiar with this was called Square a few years ago. That was rebranded as Block, and they recently changed their symbol from SQ to XYZ. So as you can see, this stock, was a $100 stock earlier at the end of last year, traded all the way down to below $50. So basically lost 50% of its value in the last year or so, and has been forming this bottoming base between, call it 50 and 60, 62, 63. Finally broke out here above that level, retested at a support, and is now starting to trade higher here. So our upside target here initially is going to be filling in this gap at 81, 82, but our longer term upside target here is close to around 85 or so to the upside. Now, Block trades at a very reasonable around 15 times forward earnings, which is quite inexpensive relative to the industry at 26 times. So it's trading at a heavy discount, and you wouldn't be able to tell why if you look at kind of growth expectations, because both analyst expectations for both top and bottom line are higher than the industry average, and net margins, they're more profitable than the industry. So, all the underlying fundamentals, point to a company that exceeds its industry on kind of the important metrics from a fundamentals perspective, yet it trades at a valuation that's 30-40% below the industry average. And that's really where I see a lot of upside potential here for the stock, especially after it lost so much value here this year. It's now playing quite a bit of catch up here, and I think is a great opportunity for investors to take a look. Another stock I want to take a look at here is Alphabet. We have looked at Alphabet here for the last few weeks. Essentially, we were looking at this on this pullback here. We waited for this pullback here to get long. The stock has moved nicely off of those highs here. As you can see, recently it's kind of stopped a little bit at this 180 level here, and we're seeing if we can get that breakout here above 180. If you get that breakout here above 180, the gap fill here is just a little bit above 200. That would be our upside target here for Alphabet. And out of the Mag 7, Alphabet trades at by far the most reasonable valuation, 18, 19 times forward earnings, which is in line with the industry. But if you look at kind of growth expectations, they're also in line with the industry, 11, 12% top line, bottom line growth, which is very much, in line with the industry. But Alphabet's net margins are 31%. So for every $1 they generate in revenue, they earn 31 cents in net income, versus the industry average is around 6 to 7 cents. So they are orders of magnitude more profitable than their peers. So the fact that they trade at a valuation that's actually slightly below its peers represents kind of the upside potential that I see here with Alphabet, and which is why, especially for those of you that are looking for investments in tech within AI, Alphabet represents, in my opinion, one of the most reasonable investment opportunities in this particular theme, because all of the more obvious ways of investing in AI, whether you're looking at Microsoft or Nvidia or Oracle, they're all trading at some significantly higher multiples. So you just have more risk, more downside risk with those types of investments. Now, I don't necessarily think Alphabet is a direct comparison to some of the other names that I referred to, but it is, by all means, highly exposed to the AI theme. So trading at 18 times forward earnings, I think, is a interesting investment to pay attention to and look at whether you are a equity or options investor. And then on the another one on the AI front, which I think is under the radar, is Micron. Because, like I said, for investors in the AI theme, Nvidia is kind of Nvidia, Oracle, Microsoft, Alphabet, Meta. Those are kind of the most obvious names to play if you're looking for exposure to the AI theme. But Micron recently breaking out above this 115 level, starting to pull back here to that support level, and that is kind of where I think the best optimal entry for further upside looks like for Micron. Um, and the stock trades at 10 times forward earnings, which is a very heavy discount to the industry at around 26 times. Now, it's important to understand that Micron operates in the memory space, which, if you think of that as a sort of a sub-industry within the semiconductor industry, um, memory, just generally speaking, trades at lower multiples. So it's not fair to say that it should be trading at 26 times forward earnings if all thing else is equal, because industries like memory, which are heavily commoditized, generally trade at lower multiples. So it's important to understand that. But if you look at growth expectations, Micron looks very similar to Nvidia, right? EPS growth expectations of over 100% EPS growth, revenue growth expected like 26-27%, which is very close to what Nvidia is expecting in terms of expected revenue growth. Net margins are nowhere near what Nvidia represents. Nvidia's net margins are north of 55%. Microns are still solid at around 18%. But it's important to understand that Micron is one of the primary suppliers of the high bandwidth memory chips that go into NVIDIA GPUs. So if you're invested in NVIDIA, think of Micron as one of the suppliers for NVIDIA components that go into their chips, that go into their GPUs. So for those reasons, I think Micron trading at 10 times forward earnings is kind of a underrated, under the radar way to get exposure to the AI theme if you are either invested in NVIDIA and you want to, have a little bit of diversification there, or if you just simply want, access to kind of the hardware side of AI exposure, but you don't want it in a stock like Nvidia that's trading at this point, I would say a fair valuation, but a relatively rich valuation overall. So Micron, I think, is worth looking at. I've been talking about this for a few weeks now. Hopefully, you guys see some of that here as well. Sorry, I didn't mean to close that out. And then looking at kind of balancing this out a little bit this week, we want to start off this week with some bearish ideas. And our new idea this week here is Tesla. Tesla just by all means is trading at valuations that make less and less sense. The stock is, I would say, at a pretty pivotal price, if you will, around this 295, 300 level here. As you can see, this is a level that has been prior support and resistance multiple times, and it looks like we're about to break down to the downside. As you can see, if we can zoom in a little bit, look at the trend quality recently has really deteriorated a little bit, and both trends turned negative here very recently. So call it let's call it the 290 level here. That's kind of the important level that I think the stock has reacted to multiple times. And the question is whether this breaks down. If it breaks down, our downside target immediately is around 220 here to the downside. But if you zoom out, this is really where I think, the downside target looks closer to around 180 or so to the downside. Looks like a reasonable downside target, basically completing this entire topping formation back down to, where it started around 180. There's, from a fundamental perspective, there's really not much to say. It trades at 160 times forward earnings, which is roughly 15 times higher than its peers. The industry average is around 11 times. And you could argue Tesla is not a traditional car manufacturer, that they have, technology embedded into it and all of that stuff. But even when you factor all of that in, right? Just look at kind of how fast Tesla is expected to grow. It is expected to grow faster than its peers. There's no doubt about that, right? EPS growth around 17% versus peers around 8%. Revenue growth around 13% versus 3% for the industry. So by all accounts, this is a company that's growing head and shoulders faster than the industry. Net margins of 6% versus the industry average around 2.7. So all around, more profitable, grows faster than the industry. There's no doubt that Tesla should be trading at a premium valuation to its peers. But even if you assign a valuation that's 3 times as high, that puts it around 33 times forward earnings. Tesla's trading at 160 times forward earnings, which means that you're looking at a valuation that's nearly 5 times higher, what we would consider as like as a significant, let's just call 33 times forward earnings as a fair value estimate, right? You're still talking about a valuation that's more than 5 times higher than what we consider as fair value. So it's really hard to justify that, especially if you look at kind of, analysts have already revised Tesla's growth expectation this year down by about 25%. And they missed those lowered estimates, or again, just a few weeks ago. So the fact that analysts, even though Tesla has a pretty good outlook relative to the rest of the car industry, but that outlook is rapidly deteriorating, and they're continuing to miss that rapidly deteriorating consensus. It's hard to justify any type of valuation remotely like this when you have that kind of business. Robotaxi, a lot of valuation attached to robotaxi. However, there's a lot of competition in robotaxi coming in as well. So I think that there's a lot of risk in this type of stock at these valuations. I'm a big fan of Elon Musk. I think he does amazing work, but that doesn't take away from the fact that the valuation here just doesn't make sense. And that's why I'm adding Tesla to my bearish list here at the start of this week. The next one I want to take a look at here is Walmart. We talked about this here for the last few weeks. Walmart continues to kind of trade just shy of this $100 level. It has kind of continued to press higher here. If it breaks above 100, that would be, in my opinion, probably a reason to no longer take a bearish position here in Walmart. And we're getting close to that level here. So this is one that we'll keep an eye out on, but it doesn't take away from the fact that, Walmart trades at a 38 times forward earnings. Usually, NVIDIA doesn't even trade at 38 times forward earnings. Look at kind of EPS and revenue growth. You're talking about 9% EPS growth, 4% revenue growth. That's below the average S&P 500 stocks. expected top and bottom line growth, net margins of 2.75%. Those are razor thin margins. So for a company like that, and like the only reason that a company like that with such low growth and low margins traded at such high multiples is simply because of how consistently they deliver those profits, meaning there's very little deviation that they tend to have from these growth rates over a long period of time, that investors are very, very confident they can deliver on those types of results, right? Versus if you look at kind of, Micron or Nvidia, they have high growth rates, they have high net margins, but there's not a lot of faith that that's going to continue on for the next 5, 10 years, versus Walmart has been doing this for so long and consistently showing those types of growth that investors are basically confident that those growth numbers are going to stay, and that's why it trades at such high valuations. And because of that, sometimes these valuations can stay very lofty for long periods of time. A good example of that is Costco, trading at 50 times forward earnings, so even higher than Walmart, even though growth expectations are basically, the same as Walmart. The net margins are 2, 3%, growth rates that are kind of in the low single digits. How does something like that trade at 50 times forward earnings at a multiple that's, even higher than Nvidia? It's really just the fact that they're so reliable in delivering those results quarter after quarter for so many years, that investors are very confident that they will continue to deliver that and they will pay, a premium for that. So you have to be able to also recognize when that happens, that just investors will not give up on this type of valuation and they will continue to pay these high valuations, which is why I think it's important that when bearish trade ideas like this break a important technical level, that you do have a way to kind of cut your losses and move on. So like I said, Walmart, if it breaks above 100, would be my reason to say, you know what, even though the valuation doesn't make any sense, a short position in this stock at the moment just also doesn't make sense either. So that's my take on how I want to approach Walmart at the moment. But outside of that, if it stays below 100, our downside target here is 91. It's not a big downside target, but that's kind of where we are looking for this range to trade back towards the bottom end of that range. And so far, it's been range bound for 2+ months. We'll see if it breaks out above that level or if it fails and trades back down to 91. Oh, whoops. Did not mean to close that out again. And then our last two bearish ideas. The first one is, again, going to be Apple, which we've talked about here quite a few times as well. Oh, sorry. AAPL is what I want. And specifically, this recent rally here, I think actually represents a good opportunity to actually enter a short position here. So even if you've been following this for a while, the rally here represents a good opportunity from a risk reward perspective to seek a bearish position here. Apple trades at around 27 times forward earnings, which if you look at growth expectations that are roughly in line with Walmart, this is Apple's growth expectations have come down substantially here in the last year, and they've continued to disappoint even those lower growth expectations. The only thing that's keeping kind of the valuations of this stock going is the net margins of 24%. And the question is whether or not they can continue to sustain that if iPhone sales continue to disappoint. And I think that there's some margin pressure that we're going to likely see here in the next few quarters for Apple. And that's why I continue to maintain a bearish position here in Apple. Just 27 times forward earnings is still high, in my opinion, for a stock like this that is expected to grow low single digits. And where the outlook for Apple just continues to look fairly at the moment uncertain. Their fairly botched rollout of AI. They've just completely have lost uh, their direction with regards to the AI and kind of what they're going to be doing. It sounds like they're no longer going to be really supporting an in-house model, and they're looking for external technology providers to provide that, which generally means that they're going to have lower margins on that. So there's a lot of things about Apple at the moment that looks quite chaotic internally that I think they really need to figure that stuff out before this can be a growth stock again. So at the moment, I think this rally here actually represents an opportunity to take a short position on Apple. And whoops, once again, I closed this out without meaning to do that. And our last bearish idea here for the week is going to be T-Mobile, which I've mentioned this in the past. The stock trades at 22 times forward earnings, which is quite a bit higher than the industry. The industry average is around 10 times forward earnings. So it's trading at about 1.2 times higher than the average industry. And the rally here recently in the last couple of weeks actually represents, I think, a good opportunity to take a bearish position. That's exactly what we just recently generated as a bearish position here on T-Mobile. T-Mobile grows faster than its peers, but it's just trading at a valuation that's way too high. So for those reasons, I see some further downside for T-Mobile. With that, that covers what I wanted to share with you here today. Hopefully that gives you a good understanding of how we are viewing the markets, and more importantly, some trade ideas to start off your week. With that, thank you so much and have